Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to leverage analysis. This is going to be a second problem of a similar nature. However, we will have a difference in it in that we will be seeing the effect of a change on interest rates as we do our comparison for different type of analysis related to the financing of the assets, one being more debt focused, the other being more equity focused. Get ready. It's time to take your chance with corporate finance. Here we are in OneNote. If you would like to follow along, you're not required to do so, but if you have access to it and would like to, we are in the 534 P1 Leverage Analysis Problem 2 Part 1 tab in the Practice Problems section. Going to be closing this back out. We're going to have our information up top. We'll read through that information. Then we'll have a smaller component of that information as we use it to work through the practice problems. We're going to be doing a comparison to the financing of the assets, one being a debt-related financing plan, the other equity-related, and then we'll make some changes, including a new change, including a change to the interest rate, to consider what would happen as we have some alternative formats for the two plans, debt and equity plan. So we got the assets at the $30,000. The debt is currently at the $15,000 at a rate of 10%. Common stock then is at the $15,000 and a $10 par value. This is basically our accounting equation. We have our assets totaling the $30,000. They are financed either with debt, liabilities $15,000, half of it, and equity the other half at the $15,000 through the issuance of the stock. So this is our basic, scenario of the financing of the assets plan between debt and equity. We have two options there now to refinancing, one leaning more towards debt, the other leaning more towards equity. So we're going to say that the return on assets before we do this is going to be 10%. We're getting a return on our assets. The assets are used in order to generate revenue. We're thinking about our return on the assets being the 10%. The tax rate's going to be 35%. And then we're going to have our plans here. So the debt-focused plan is going to be the one we're going to issue more bonds. We're going to issue 8,000 of bonds. We're going to have to pay 13%, which is kind of high on the rate on the bonds. We're going to take that $8,000 and we're going to buy back the stock for it, with it, and that's going to reduce the amount of stock that is outstanding. So that's going to be reducing the amount of the net income that we have to distribute over the amount of shares that are outstanding. The current price to buy back is $10, so we're going to be buying it back at $10 with our $8,000 that we're going to get from the issuance. And that means we can buy back 800 shares. Note that the par value is the same as the price. Don't let that throw you off. That's just going to be simplifying the process here. So then we have the equity plan. The equity plan is going to be where we're going to now focus on equity, increasing equity, lessening debt. How are we going to do that? Well, we're going to issue out shares now of 800 shares at $10 because that's the market price. And that means we're going to get $8,000 for the issuance of the shares, giving more, equity interest in the company, meaning the earnings of the company will now have to be distributed over more shares that are outstanding. But now we have that financing, that money, and we could use that then to pay down the current debt, which would be taking our financing plan of the assets now, moving it more towards equity and away from debt. So then if we had our same information up top here in a little bit smaller framework, we can go through our worksheet. We're going to basically have an income statement. We're going to start the income statement, however, at the bottom line of the earnings before interest and taxes, because that's the point at which the differences will take place. After that point is where the differences take place on the interest and the taxes. So we're going to have the earnings before interest and taxes. We're going to say there's a return on the assets of the 10%. Here's the huge calculator, so we can calculate that. Let's make it a little smaller. We're going to take the 30,000 times the 0.1, 10%, because that's the return we're getting. So that's going to be under the current plan, the debt plan, and the equity plan, 3,000. That's going to be kind of like the bottom line of the income statement before we take into consideration the interest and the taxes. And that's where things change on the interest. So the interest then under the current plan, before we do anything, we currently have debt outstanding of 15,000 and we pay 10% interest times 0.1. That means we're paying 1,500. On the debt focused plan, we're going to be taking out another 8,000 of debt and using it to pay off the equity. So let's do the calculation out down here, little sub calculation down here. We're going to say, all right, the beginning debt was at the 15,000 times the 10%, which we just calculated. That's that 1,500. Then we're going to be issuing new debt of 8,000. The rate now is higher now. We got to pay more because that's kind of what happened with the bank. When you take out more loans, they get a little nervous over there sometimes, and then they increase the interest rate when they get nervous, which is annoying because, you know, we're totally good to pay it. But in any case, then we have the 8,000 times the 13%, and that's going to give us the 1,040. So now we have the 1,500 plus the 1,040 gives us the 2,540. So that's going to be the amount of the debt-related plan. And then on the equity-related plan, what we're going to do is we're going to actually issue stock. And we're going to take $8,000 because we're going to issue the stock at $10 and we're going to get $8,000. And we're going to use that to pay down the current debt that we have on the books, which was this 15, which will lower the amount of interest. So let's just take a look at that calculation real quick. We're going to say the beginning debt was $8,000. We're going to subtract out the beginning was $15,000 minus the $8,000 that we're going to pay down with the use of the money that we got from issuing the stock. And that's going to bring our new balance down to $7,000 times the interest rate that we originally started with. That being the 10% on the original debt means that we have now only $700 of interest, which is nice because we can handle that. That's something we can do. So now we have the $700 of the interest. If we subtract this out, then we're going to have the earnings before taxes at the $1,500. The debt plan is going to be lower, the $460, and then the equity plan being the highest plan because, of course, we took out the money. But notice there's a trade-off because now we have more stocks out there that we're going to have to distribute the earnings over. Then if we calculate the taxes, you'll recall, was 35%. So we're simply going to be taking that amount and multiplying it times the 35%, 1,500, times the 0.35. That's going to be the 525. If we do that all the way across, then we, of course, are paying more taxes on the equity plan than on the debt plan. Why? Because on the debt plan, we had to pay interest, which was really not fun. You know, we don't like that. But at least we get to deduct it for taxes. And then, you know, it's just a matter of who do you like paying. You know, we have to pay the bank more, but we don't have to pay the government as much, you know. So then we got the 161 for the taxes here, and then we pay more on the equity plan there. And then we have the earnings after the taxes. So if we subtract these out, then we have the earnings after the taxes. And now, of course, the debt plan is lower than the equity plan. So we have the highest net income from the equity plan because we don't have to pay as much interest, but we have to allocate that over more shares of stock. So if we then consider the number of shares, we're going to say, all right, how many shares are outstanding now? Well, we started off with 1,500. How do we know that? Because we had the 15,000 in common stock divided by the par value of 10. That's our 1,500. And then under the debt plan, we're going to be buying back stock at the $800. We're gonna take the $8,000 and we're going to use it to buy back stock. Now, notice the price we're buying back is $10, which is the same as the par value, which is, you know, not always the case, typically not the case, but it's going to simplify our problem a bit here, so don't let that confuse you. So we have the 8,000 that we took from the bonds that we issued, divided by the market price. We're going to buy back shares then of $800. So we started off with 1,500 shares minus the 800. So I'm going to say minus the 1,500, the difference being the 700. So now we have 700 shares on the debt plan. So we don't have to allocate our earnings, even though we don't have as much earnings, we don't have to allocate it over as many shares, which is kind of nice. But then on the equity side of things, we did basically the opposite. We issued more shares, 800 shares at $10. So now we sent 800 shares at $10 and we got $8,000 and we paid down the debt with it. So that means that we actually have more shares here, which is 800 more shares plus the 1.5 that we had before. That's going to be the 2,300. So then if we were then to think about the earnings per share, we can divide this out and say, how much are we getting per unit of stock, basically? Well, we had before the 975 divided by the number of shares out there is going to be the 0.65. Now, remember that this earnings per share does not represent like how many owners there are per se, unless every owner only has one share, but it does represent how many shares or equal units that we have distributed. And of course we had to distribute them to more owners, most likely, to generate, to generate the revenue on the equity side of things. So obviously the equity side of things has the biggest net income. The question is, now thinking about how we have to distribute that over more shareholders. So how does this stand from a per unit basis that is outstanding? So if we did this for the debt focused, we have the 700 divided by the, that's backwards. The 299 divided by the 700. That's going to give us the 0.43. And then on the equity plan, we've got the 1495 divided by the 2300. That's going to be the 0.65 or 65 cents. Now you'll note that the current plan and the equity plan, although they have different earnings or net income amounts, have the same amount for the earnings per share. Why do they have the same amount for the earnings per share? Well, you'll note that the rate here for the assets is the same on the return on assets before interest and taxes. So we actually end up in the same place there. The debt-focused plan is going to be a little less. Why is it going to be a little less? Well, there's no change in the earnings, and we have a fairly high, basically, interest rate here. So the interest rate is going to be a fairly high interest rate. So we're looking at a worse scenario for the debt. You would think the things that might change this would be if the return on the assets would increase, or if there was the interest rate for the debt would go down. And of course, the market price could also have an effect as well in terms of the market price for the shares that would be issued. Okay, so now let's go down and take a look at our second scenario. We're going to calculate the earnings per share if the return on assets before interest and taxes was 13%. So now we're going to be increasing the earnings. So we haven't increased the assets. So, we could think of this, another scenario we could think of is increasing the assets at the same return. But now we're going to get more of that return due to the fact of we're not doing that here. We're going to keep the assets the same, but now just because of the market, we're getting a bigger return on it. We're saying the return on our assets is 13% as opposed to the 10%. What's this going to do? You would think that this would favor then the debt plan. The leverage might look better under a situation where the earnings are going up now. So that would be the assumption that we would typically make, all else being equal. Let's take a look at it. We're going to say then that the earnings before interest and taxes is now going to be, we have that same 30,000 of assets here. We didn't buy any more assets, but because of the market or whatever, times the point, we have increased this to 0.13. So we have the earnings before interest and taxes to 3,900 there. We see that the interest now is going to be the same format we did before. We had the 1,500 beginning, 2,540 for the debt plan, 700 for the equity plan. Same layout we saw in the prior presentation, or in the prior scenario. And that's going to give us then the earnings before taxes to 2,400, the debt 1,360, and equity 3,200. Then the taxes are going to be at that 35%. So 35% taxes. So the 2,400 times 0.35 or 35%, 840, 1,360 times 0.35 or 35%, 476. There could be rounding here. Be aware of rounding. So that means, of course, that the taxes are still going to be lower for the debt-related plan because they got to deduct the interest there. So then we're going to say that we have the earnings after the taxes. And so if we subtract out the earnings before the taxes minus the taxes, we get the earnings after the taxes. We see, of course, the equity plan is higher in terms of the total earnings because they didn't have to pay the interest related to the financing. They've paid it with equity. However, they're going to have to distribute that equity over more shares because they paid down the debt through the issuance of equity. So then let's take a look at the number of shares. Same breakout for the shares, same explanation we saw up top, meaning we have our shares 1,500, 700, 2,003. Same breakout of the shares now, but now we have a different amount of the income to be distributing over them. So if we were to do that, we're going to say, all right, we've got the 1,560 divided by the 1,500. That's going to give us the 1.04 here. And then if I go here, we got the 884 divided by the 700. We've got the $1.26. And then if we take a look at the equity now, we got the 2,080 divided by the 2,300, and we've got the 0.9. So now you can see as the return is increasing, you can see that leverage is doing its magic here. It's looking more to have nicer to have the leverage plan. Now again, notice that the leverage, if things go down, could cause a problem, and it creates more risk as you are more leveraged, which could cause negative perception of you, both in terms of lenders who are you're trying to get leverage by getting loans, and the bank might be skeptical of the risk involved, as well as the market that could be involved in that. But you could see the effect that the leverage can have, and you can compare it to the scenario here as we move forward. Now let's take a look at the next scenario. We're going to calculate the earnings per share if the return on assets before interest and taxes was back to the 10%. So we're back to the same return we had before, the 10%. But now we're going to say the interest rate is a little bit more reasonable. It's now 8% as opposed to the 13%. The 8% being less than the return on assets and less than the prior interest rate. So we started off up top. Then you'll note when we worked it out with the numbers up top, at the interest rate of the 13% on the new debt, it looked like the debt plan was worse off for earnings per share. We would expect then if the interest rate was to drop to something more reasonable, then the debt plan, of course, will look better. So let's just check that out. We're going to say, all right, we've got the earnings before interest and taxes is back to the 3,000. That's going to be the 30,000 times the return on assets, 10% or 10%. Same here. Then we're going to say the interest. This is where the change has happened. Now we're going to say the interest. The original interest was that 1,500, the same there. And then we're going to pick up the interest on the debt focus plan. We've got the 15,000 times the 10%. That's going to give us the original interest of the 1,500. Now we have the new debt of the 8,000. Now it's only at 8% as opposed to the before, which it was at 13%. That's going to give us the 640. If we add the 1,500 plus the 640, we're at the 2,140. So we have the 2,140 here. The equity interest is going to be the same because it's going to be the interest on the original loan that we paid down. So that 700 is the same as the prior scenario, only difference being on the debt plan. Subtracting out, now we have the earnings before taxes on these three items. The debt plan, of course, still lower than the equity plan because they do have to still pay the interest even though it's a lower rate. Taxes then, the debt plan has a lower tax than the equity plan because they get to deduct the interest. And then the earnings after taxes is going to be here. Once again, the equity plan, of course, being higher, even though the debt plan is now paying a lower interest rate, they still have to pay the interest rate, of course. And then we think about the common stocks now that are outstanding. And if we divide these out, the common stocks are the same for this scenario that we had in the prior scenario. Here it's just the interest rate that has changed. And if we divide this out for the debt plan, the 559 divided by the 700, we're now at about the 0.8. So you can see once again that the debt plan also looks better, of course, if the financing on the interest could be better because the equity plan still has a higher net income, but in order to refinance it, we had to issue the more stocks. So now we're distributing that net income over more units, over more shares, whereas in the equity plan, we are distributing a lower net income over less shares. We don't have to dilute the earnings by distributing them over as many shares. So obviously that would have a positive impact when we're considering our refinancing plans. So once again, the other thing you want to consider with the leverage then is what would be the scenario if a company possibly wants to maintain the return here. That's not going to change, but they want to increase the assets. They want to finance an increase in the assets either through, equity or through debt. So that's the other kind of scenarios and possibilities that you could run through with regards to financing of the assets.